In virtually all scenarios, if you're a holder of cash or bonds, you end up a loser when the panic happens to the currency, when there's a currency crisis.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 23rd through September 30th, 2024, while supplies last. First, we feature the 1-ounce gold Argor Heraeus Dragon Bar at just $69 over spot. Next, the 2024 1-ounce silver American Eagle is just $5.25 over spot, the lowest premium in months. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, retired Managing Director of Wealth Management. Clive, thank you so much for joining us today.
Hello, Elijah, and thank you very much for having me on your show.
Well, it's great to have you back on. I did want to discuss, what is happening in the markets after the announcement that the Fed is going to be cutting interest rates by 0.5 point last week. We got that announcement. So your perspective on that, I know we've seen a rally in the stock market. We've seen gold now at all-time highs above 2,600. It seems like every day now gold's making an all-time high. But your perspective on the Fed rate hike and the market's reaction?
The market was uncertain what to expect. There was a sort of 50-50 whether it would be a 25 basis point hike reduction or a 50-point reduction. We got the 50 points, the larger of the two. I don't think there was a right answer for the Federal Reserve. Probably, with hindsight, they should have made the first cut back in July, and then they could have done another quarter cut here. There's a certain feeling that they've cut by the full 0.5% because maybe the economy is not really as robust as we've been thinking. And I think the main reason for that, and Jerome Powell has said it himself, is the labor market. We're looking at a situation where, first of all, those job numbers, which have been coming in month after month, terribly good, look like they've all been way overestimated. Every month they reduce the previous month's figure and the month before that. And it's habitual. And when you do that, it makes the current month's figure look, or the increase in jobs, look that much better. And then about a month ago, they revised down all the numbers through to March this year by nearly 1 million jobs. So the actual growth in jobs is nowhere near as has been they've been making out. And if you look at the household survey, which is a different way of looking at things, the household survey also counts jobs, but it actually counts the number of people working. So the number of people working is less than it was a year ago, even though the number of jobs has gone up. The number of people unemployed is more than it was a year ago. And that's with the benefit of 1.9 million legal immigrants coming into the United States to work over the last 12 months. So we've got a huge increase in the number of people coming into work with legal jobs, yet the number of employed people has fallen. So really, it does say something about the economy, and certainly the American economy, maybe not the immigration community who are coming into work, that people are not really finding jobs as easy as they should have done. And I think that's being recognized now by Jerome Powell. And I think that's the reason he cut by more than expected, or it was sort of 50-50. So the question is, are we actually in a recession, or are we heading into a recession? Well, it certainly looks to me like we're heading into a recession. The official numbers don't say we're in a recession yet because we need 2 quarters of GDP down. We may get that because, don't forget, they revised down the last GDP number that came out. So if they revise out the next one or the next 2, it could well be that we're in it could well turn out that we're in a recession already and just didn't know it. So I think that's the first point, that the economy is definitely slowing. Maybe we're going into recession. And we've also got the cut in interest rates. So what does that mean for investors? Well, one of the things, let's talk about the bad side of the economy first. if we're going into recession, that's not going to be very good for cyclical companies. So what are cyclical companies? These are the companies where the demand tends to fluctuate according to the state of the economy. So, for example, if we have less people working and there's less money in the economy and people are uncertain about their jobs, they'll be buying less luxury goods. They'll be buying less automobiles. Many manufacturing companies will find that their orders are slowing. So these are some of the things to avoid. You also want to avoid in a recession high debt companies. Those are companies which have got a high level of debt relative to their equity, and or companies which have got poor cash flow relative to their earnings. Don't forget, earnings and cash flow are not at all the same thing. A company can have positive earnings because it's revalued its properties or it's revalued its stock. That's not cash coming in the door. So whenever I look at a company and trying to decide if I'm investing in it, I not only look at how much its earnings are, I also look at how much its cash flow is. That information is readily available. But if you've got a company which hasn't got a lot of cash flow and we go into recession, it's going to become much harder to service its debts and pay its employees. Do look at, in a slowing economy, do look at companies with strong cash flow, look at companies which have got relatively low debt to their equity, because those who've got high debt to equity are going to struggle a little bit if their sales go down. Another area to avoid, probably if we're going into a slowdown economy, are the financials. That would include the bank, or mainly the banks. The banks have been making hay recently because they could earn 5.5% by depositing money with the Federal Reserve, yet they were only paying most of their depositors 1 or 2%. So as interest rates go down, the margins for the banks get squeezed. That means their profits tend to go down. So we're in a falling interest rate environment. That's probably going to squeeze the bank's profits a little bit more. And of course, coupled with that, we've got a commercial real estate market, which is in a pretty dire straits at the moment because more and more companies are realizing that first of all, there's the work at home phenomenon, which is carrying on. Companies which used to have 5 floors now need 3 or 2. And we've got another thing going on, which is the hot desking. I know when I was working most of my career, we had a lot of paper in our drawers and piles of, you had your in tray and your out tray, and your clients sent the paper, and they filled in forms. You had to process the paper manually. But in recent years, that's all gone digital. Paper will come into the firm, it gets scanned, and you can go to any computer anywhere in the building and you can log on and you'll see the paper which is destined for your processing on your screen. It's not hitting your desk. So you don't need to sit anymore at a specific desk. So that's called hot desking. And more of that's going to happen, which again means less space is needed because you've never got an office where 100% of the staff are turning up for work. So commercial real estate is going to continue to be in trouble, but that's also not a good thing for banks because sooner or later, some of these commercial real estate, the people who've borrowed on their commercial real estate, they're going to say, there's no point anymore. My tenant, his lease has come to maturity. He's stopped paying the rent. I can't get anybody else in, or if I can get them in, I can only get them in at half the rent. It doesn't make sense. I'll give the keys back to the bank. Thank you very much. And that means the bank potentially loses money, potentially a lot of money, because it could well be that in certain cases, the total rents being collected are less than the city taxes, especially if you have a nearly empty building. That means your building is actually a liability. It's worth not 0, it's worth less than 0. So, the banks might have some losses ahead of them. I'm not suggesting that we're going to have a banking crisis and all banks are going to go bust, but certainly you probably don't want to be looking at those as an investment because the profits will be going down. Another area which I think is to avoid in a recession is insurance companies. It's a very funny thing, but for some strange reason, there seem to be an awful lot more fires in warehouses during a recession. More cars seem to crash or catch fire. There's a lot more burglaries, and people have more claims for other things like medical claims and so on. Just one of those funny things about recessions that the number of claims go up. Whilst at the same time, if you're an insurance company, you're keeping cash on the side to pay all those claims, but the interest rate you're earning on that cash after the Federal Reserve's interest rate cuts will be going down. And we mustn't forget, this is the first of many cuts that we're expecting. So those are the sort of things you probably don't want to be investing in at the moment, or maybe lightening up on if you've got those investments. But what should you earn when interest rates go down? Well, of course, interest rates, in a way, if they go down, it is quite attractive for all asset classes, including equities, because it means that the alternative way you're going to put your money, which would be cash on deposit, isn't as attractive. Therefore, everything else looks more attractive. But let's look at the things which hopefully survive quite well during a recession and possibly go up. I mean, they won't necessarily go up, but they certainly should survive well. This would include what I call consumer staples. So consumer staples are things like food, beverage, household items, personal care, healthcare, the kind of things where you're not going to change your spending on these items, even if you're worried about your job. You're not going to buy any less toothpaste or soap or washing powder, or drink less. I won't say the name of the soft drink, but let's say soft drinks, or eat less food. Another area which is probably fairly safe if we go into a slowing economy are the utilities, things like electricity companies, water companies, natural gas, those sort of things. Healthcare should be all right. I don't see people cutting back very much on their medicines. So the large healthcare companies, which have got medicines that we buy every day, are likely to do okay. I don't want to say any of these are going to do great, but they'll be doing okay in a recession. And then, of course, there's things like the telecommunications industry. They've got a very stable cash flow. We probably won't spend any less money on our telephone bills just because there's a recession. And maybe the last thing to look at, and this is in contradiction to what I said earlier about commercial real estate, but I'm going to discuss just briefly real estate investment trusts. There's lots of real estate investment trusts that some of them are linked to commercial property. I probably wouldn't go there yet. I think it's too early. But in a falling interest rate environment, one of the costs which a real estate investment trust will have less of, that's interest cost. Whereas the rents, if you've got the right sort of real estate, and this is the important thing, which sort of real estate is it? If you have the right sort of real estate, the rents are probably not going to go down. They're probably going to drift upwards. So in a falling interest rate environment, real estate investment trusts, not all of them, but some of them can be quite attractive. I'll turn to gold and silver, Elijah. Gold, which has no income, should be a natural beneficiary of lower interest rates. I think there's a number of other drivers for the gold market at the moment. That's geopolitical uncertainty and also concerns across the board about the levels of government debt, not just in the United States, but in Europe, Japan, UK, and elsewhere. Governments have got into the habit, especially during the COVID pandemic, of spending more than they can collect in taxes. And that's causing the levels of government debt to increase because the governments want to keep spending. Now, if you think about it, when the government spends money, they borrow the money from somebody. Doesn't really matter who they borrow it from, or they might borrow it from the central bank. They borrow the money, the government gets poorer, and they give the money to somebody, and somebody gets richer. So as we get more money on the planet, there's more to go around for the purpose of buying everything and anything. And when you have worries about the government debt, one of the places you're likely to go is into something which will conserve its value, and that's gold. It's a relatively low risk asset. Of course, it does go up and down, but it's not going to fluctuate with this speed and excitement that equities have fluctuated at. Obviously, equities have just had a straight line up for the last decade or so, but when they do decide to turn down, equities can turn down with a vengeance. I think if gold does turn down, it'll be fairly modest. I don't think we're going to see a 25% decline, but 25% declines in stock markets can happen very, very easily. So I think the lower interest rates are favoring gold at the moment. I think the economic backdrop is favoring gold. The worries about the levels of government debt are favoring the gold. And of course, something which we did discuss before on our previous program was the question of whether ultimately the currencies have to be reset. We have to start with, give up on the old currency and start with a new one. I mean, I'm not saying that's going to happen tomorrow, but if we get into some sort of emergency, some black swan event, it could happen. They could say, okay, there's a big war, or there's been an earthquake in California, or there's a new plague or pandemic, or whatever it happens to be, or there's a meteorite hits the earth somewhere. Not our fault. We're going to have to, for emergency reasons, restart the currency. And here you are, everybody, here's $100 new or $1,000 new or $10,000 new, and get on with it. And they basically back out of the old debt. Now, that wouldn't be a default. It would just be saying you can't spend it. So obviously, the levels of debt, at some point, it's the straw which breaks the camel's back. We don't know how far away we are from it. Nobody knows. And nobody knows when the panic starts, or if one starts. Maybe it could keep going for 10 years. I don't think so. And certainly some of the most famous people on the planet, to do with finance, from Ben Bernanke to Janet Yellen to Jerome Powell, have voiced their concerns, saying the level of debt they've got in the United States is completely unsustainable. So has virtually every president. Well, not virtually, actually, every president who's come into power in the last decade expressed concerns, yet the debt just goes higher and higher as a percentage of GDP, and nobody knows how long they can keep that going. But I don't think they can keep going forever. I think at some point it all comes to a grinding halt as people say, I don't want the dollar, or I don't want the pound, or I don't want the yen, or I don't want the euro, and they start to look for other things. And what will they look for? Well, the man in the street will probably take everything which is on the shelves of the supermarket, and the wealthier will try and put their money into real estate, into equities, and of course, gold. What do you think, Elijah?
No, I mean, it seems like that's what we're seeing a little bit of now, is people moving more into precious metals, other countries buying gold, right? Central banks buying gold is what we've been seeing. I did want to discuss a little bit about that and this reset that we've talked about before that you see that could be occurring. What would happen then to other financial assets, right? So you have your stocks, your bonds, everything like that are dollar denominated. What do you think would happen in that case for these traditional financial assets?
So I think the word reset is a relatively new word. In the past, currencies have failed, and this has happened all around the world over and over again. Not so much in recent years, but in the 20th century, there were a lot of currency failures, and before that, even more. And when those currencies failed, the winners were generally those who owed money, and the losers were generally so winners were those who owed money and had assets, and the losers were generally those who owned the money, because we're talking about paper money failing here, because not gold, because if you have the gold, you're going to be fine. But if you have paper money and the currency fails, well, you've got a claim on nothing. And I have I don't do it anymore, but in my younger years, I used to collect banknotes. And one of the fun things about banknotes, I could find from all around the world these banknotes with more and more zeros, and it became a sort of passion for me to see which banknotes I could find with the most zeros on them. And you'll find country after country after country, where they started with one, and then it became 10, then it became 100, then it became 1,000, then it became a million, then it became a billion, and then it became 100 billion, and so on until they restart the currency. So we're not there in the Western countries by any means, but you never know when things start to speed up. And when they start to speed up, it's going to be difficult, more difficult anyway, to buy things that you'd like to buy to protect yourself. So I think those who are holding large cash balances need to think about it earlier rather than later, so that they can deploy their money into something other than short-term deposits, where potentially they're at risk if there's suddenly a rush for assets, and they say, "Oh, rush for assets! Oh my God!" But I don't want to pay 50% more than it was a month ago. That doesn't. That's going to hurt. and then they'll be left holding the cash, and then one day suddenly the government switches off. And I can tell you in a minute how that might happen. There's one scenario which could work for many governments without actually having a default.
How do you think that reset, as you're saying, would play out?
So this is one of several scenarios. So I don't want people to take this as being the only thing that will happen and the thing which must happen. But in virtually all scenarios, if you're a holder of cash or bonds, you end up a loser when the panic happens to the currency, when there's a currency crisis. But in this particular scenario, which I'd like to discuss, which I think is probably a fairly high up on the list, maybe it's as much as 50% probability, I think it comes about in a few years' time after governments have got the central bank digital currency up and running. Now, that's the CBDC, and I know there's a lot of opposition from parts of the population, myself included, to this, but I think many governments are determined to go ahead with the CBDC. What people really have to understand is, although the central bank digital currency will look like and feel like your existing credit card, it'll look like and feel like the cash in your pocket, and the money in your bank, you can move the money from your bank to your CBDC wallet one for one, no problem with that. And you'll have probably two types of wallets. You'll have your CBDC wallet held by your bank, and you'll have your CBDC wallet you're carrying around on your phone. Most governments who've got this coming have hinted at there will be some sort of limit as to how much money you can have in your personal CBDC wallet. I think the Bank of England has bandied around a few numbers from £5,000 to £20,000. I haven't actually seen specific numbers anywhere else, but I'm sure they must be out there. What I think will happen with the CBDC, which will ultimately lead to the possibility of a reset, is this. I think in the early days, the central bank digital currency will be running alongside your other types of cash, your bank account, your credit cards, the cash in your pocket, which in many countries there'll be rules to say it's still legal to use cash, the paper cash in your pocket, or the money, the coins in your pocket. In fact, in Switzerland, we're shortly going to have a referendum on that to force the government to agree to keep cash in circulation despite the CBDC, which is planned to come. But I think, realistically speaking, over time, the use of cash will fade away because people just see the convenience of paying digitally. They already do. I mean, a lot of people just don't carry cash around with them anymore anyway. They pay everything with their watch or their phone or their card, depending on the person. So I think once the CBDC arrives, people will say this is just a continuation of the same. It's much of the same. But what people have to understand, it's not the same. The central bank digital currency, although it's called dollars, pounds, yen, euro, whatever, and although you can move your money from your bank to your wallet one-to-one, it's not at all the same. The central bank digital currency is, to all intents and purposes, a currency created by the central bank, just like the banknotes have been created by the central bank in your pocket. It's not at all the money you have in your bank, which is effectively created by the bank's credit system. Now, what does that mean? It means that over time, they're going to start to say, we want people to use their CBDC wallet for all transactions because it will assist us in anti-money laundering, making sure you're not a terrorist, making sure you're not dealing in stolen money, and of course, it'll help us to collect the tax on transactions. You know, the black economy will disappear. So all transactions have to be via your CBDC wallet. Now you're forced into a situation where anytime you want to do anything with your money, you have to use your CBDC wallet. You want to invest money, you tell your bank to use the CBDC wallet at the bank. You want to buy something in the shop or pay the man who knocked on your door offering to cut your garden. You're not going to pay him cash anymore. You're going to pay with your wallet. Don't ask me how you're going to pop a banknote into that birthday card for your granddaughter I guess you're going to have to send her a CB. I don't think will be such a thing. We have to send her a CBDC code so she can download it to her wallet. But we get to the point where the only way to transact will be on the CBDC wallet. And then one day, and I'm speculating here, there's a crisis. And the public at large are rushing down to the shops to buy whatever they can, called hoarding. Of course, they might be able to control that by saying you're only allowed to buy one toilet roll and one bag of flour and one bag of sugar, because we control what you're allowed to do with your CBDC wallet, because it's programmable. But at the same time, those who've got a bit more money will be speculating against the currency. What do I mean by speculating? It means they'll be buying anything they can but the currency, which means that the price of tangible assets will be rising and the currency will be going down. There'll be a complete loss of confidence in the currency. So what do you do when that starts to happen? Well, there's many things the government could do, but one thing they might well do is say we're going to limit what you can put into your CBDC wallet unless you get permission. So you might get permission for some things, but if there's a chance that you're doing it because you're speculating against the currency, like buying something, the answer is no. If you're putting money into your wallet to feed your kids, well, probably they'll say no problem if it's up to X, $20,000 or $10,000, whatever the figure they decide. But if you want more than that, you better have a bloody good excuse to justify it. And if your excuse is you want to buy something, well, sorry, that sounds like you're speculating against the currency. So the answer is no. So we find we've got not only a bottleneck on what you can put in your CBDC wallet, but it might be a bottleneck where it gets closed off completely. Of course, they would call it a temporary restriction, but the word temporary usually means, in this sort of situation, permanent. So you'll find that at some point, the money you've got in the bank is effectively undeployable because you can't spend it on anything. You have a maturing bond from a well-known company like Microsoft or Apple. It comes into your bank account, but you can't move it into your wallet and spend it on something more tangible. Perhaps you'd like to buy some antiques or a house or some gold, whatever. You won't be able to do that because it's bottlenecked. So what does that mean from the government's perspective? It means that they no longer have to worry about their levels of debt when it comes to managing the economy, because that debt can't now be, or the worth of that debt can't now be moved into the economy, destroying the economy. So, but they will be able to borrow in central bank digital currency, which means that they're starting with a debt to GDP ratio of 0 instead of the 100% that we've got in most countries. So if you start with a low debt to GDP ratio, you'll be able to bail out all those who are hard done by due to this action of bottlenecking the conversion to CBDC. So one of the obvious candidates for being bailed out are the pension funds, because the pension funds own lots and lots of bonds, which are now effectively unspendable. So you'll be able to pay your pensioners the old currency, but the pensioners won't be able to do much with it. So it's quite likely they'll decide to some extent to bail out the pension funds, and they'll probably arrange to give everybody a universal basic income to sweeten the deal so nobody starves. That would be a nice one. Of course, your salary, your dividends, and your interest will, maybe not your interest, but your salary, your dividends will be going most likely into your CBDC wallet. But, as for moving your capital, your old capital into it, probably the answer is going to be at some point, no, you can't do it. There's another form of capital control. We've had capital controls around the world over and over again, and in my lifetime and in the UK where I used to live. When I was an adult, we had what's called exchange controls. So this is just another way of limiting what you can do with your money. And effectively, if we get to this bottleneck situation where they shut off the ability to move your old capital into your wallet, the economy is effectively only running now on the new money. not the old money. The old money can't come and destroy the economy, so that the government's debt is still there, but it's fading away into worthlessness because nobody can spend it. Nobody wants the old currency. Perhaps on day one, the old currency will be trading at 70 cents on the dollar. People will say, well, you give me an old dollar and I'll put 70 cents into your CBDC wallet, a sort of black market transaction. And I bet you 3 months later, it'll be at 20 cents on the dollar. And a year later, it'll probably be nothing. So this would be one possible scenario for it, which would favor the government. But of course, there's going to be an awful lot of people who are bank holders. Bank holders are the ones who are holding the monetary assets, money market funds, bonds, deposits, and cash in the bank, which is not in your CBDC wallet already. So it will create a problem for all the people who have monetary assets, but it will create a bonanza for everybody and every company which owes money. Because from the positive side, as far as companies are concerned, they all have debt, which is denominated in the currency, the lawful currency of today. Now, unless they pass some law to say everything is converted to the new currency, one for one, that would be a stupid law, because there would be no point in having a new currency if they pass such a law. Then you wouldn't bother with the new currency. But companies have all this debt in the old currency, and suddenly this old currency becomes effectively worthless or defunct. That means the companies are going to be writing up a large profit thanks to they're writing down the value of their liabilities. Those liabilities are heading to zero. So the companies are able to reborrow and build more factories. That's very good for the economy. The man in the street is no longer burdened by his mortgage or his old credit card debt, which is still left behind in the old currency. Now, I'm not saying the bankers will let that happen. It's quite probable if we haven't got them already out, we'll see some currency reset clauses creeping into contracts, like mortgage contracts. I've already spoken with one American lawyer who tells me that she is already writing that in for the benefit of those who are owed money. So it would go, let's say you're building a factory or buying a piece of machinery which will be delivered in a year. Effectively, the one who's going to receive the money wants to be sure that the money is still going to be worth something by the time they get it. So currency reset clauses are being written in. I mean, you can imagine an extreme example. This wouldn't happen in the United States, but let's say you're in a particular country. We go back 100 years, and Japan has invaded Hong Kong. What happened? Well, the Hong Kong dollar, or the dollar of Hong Kong at the time, became effectively worthless, and the new currency became the Japanese currency. So that would have been a great time when a currency reset clause would have worked, because you had the people who, but they didn't have such things back then. But anybody who happened to owe money in the old currency found it was actually worthless. And anybody who had deposits in the old currency lost all their money, because there was a new currency came into existence, and that was the yen, and that started circulating. So I'm not suggesting that we're going to have an invasion and some enemy is going to force a new currency on us, but it could be your own government in an emergency situation, for your own good, of course, they'll say. And the man in the street will not be burdened by this, so he'll start spending a lot more. He'll be able to rehypothecate his house, because you know how people are. They tend to, if their house is worth more than their mortgage, they tend to spend the difference. There's a lot of people who do that. So I can see that encouraging people to borrow and spend. So the economy will be booming as the man in the street spends more. The government will have a lot more money in its coffers because it won't have borrowed so much that it can embark on all kinds of programs of spending, infrastructure projects and anything else they like, and bailouts and universal basic income. The companies will be doing great because they've got rid of all their debt. But don't forget, there's a lot of losers who are going to, and that will include you and me, because I'm for certain going to be holding some cash. The question is, to what extent will the losers be losing. So if you've got all your money, 100% in cash, and it's a lot, you're definitely going to be a loser. If you've got a small amount of cash, I don't think you'll be a loser at all. I think the government will see the man in the street, the 95% of the population who struggle to put a few $1,000s together. I think they'll be just fine. They'll just carry on as they did the day before. But someone out there, and that would include people outside your country, people all over the world, are holding either physical cash or bank deposits in the currency of another country, like the United States or the United Kingdom or Europe. And, those will be large balances. And because they're not citizens of their own country, they will not be bailed out. They're not citizens of the country which they've got the money currency in. So this is a scenario which might happen. There are lots of other scenarios which may happen to solve the debt problem, because this is a kind of situation where the debt is the problem. Another one which has been used in the past in other countries is what's called the bail-in. This is where the government says you have a certain amount of money in the bank, whether you like it or not. 90% of that is now lent to the government for 5 years at 2% interest. But by the time you get it back, it's worth nothing. You don't know that's going to be worth nothing, but obviously it will be worth nothing by the time you get it back, because the government's had to borrow it to spend it. So that's a bail-in. If the country in question prints its own money, I don't think there's no chance of a default. You don't default when you can print money. So that I don't think will happen. Another way out is a hyperinflation scenario. It may be pretty awful for a lot of people, but it does solve the debt problem, because in a hyperinflation problem, a situation, the government will be borrowing from the central bank as opposed to you and I. But there's the multiplier effect of 5-10 times, which means that every dollar which is borrowed from the bank through the lending and redepositing, the money circulates, it works out at 10 times, maybe 10 times as much. And of course, in a hyperinflationary scenario, the money moves even faster than that. So it could be working out at 20 or 30 times as much. So if they borrow from the central bank because nobody else will lend them money, we start to have a lot of money coming into circulation from the central bank, effectively electronically printing, and that will cause the money supply to go up. Therefore, the GDP goes up, and the GDP will be going up because of the multiplier effect, and the amount of money going up will be going up much faster than the level of debt. So the result is the debt to GDP ratio in such a scenario would be coming down. But the negative side of that is very rapidly rising prices. And of course, again, if you have cash or you have bonds, you're at the wrong end of that.
When it comes to people who have debt or people who have a mortgage, right, or people who have credit card debt, from my perspective, it seems like a much safer situation to pay off that debt, right? But it sounds like there is a scenario in the future where maybe that debt could be canceled. So your perspective on that, how we can't give financial advice, right, on this channel, but in your view, do you think it's safer at this time to, reduce your liabilities, pay off the debt, or do you think it's better to kind of wait for that situation or hope for that situation where debt could be canceled?
I've been asked this question several times in the last few weeks by people via LinkedIn. I often reply to questions that way. And the answers aren't always the same, because it depends on the situation. So as a generality, and this is really just a generality, it's not financial advice, if you are somebody who has more than sufficient income and sustainable income that you can afford to pay the interest on your mortgage and have plenty left over, I don't really think there's any point or any good reason to pay off that mortgage at the moment, even if you've got unless, of course, you have the cash and you don't know what to do with your cash. But if you've got a choice, if you're the sort of person who likes to buy things, anything, whether it be tools for your garden, plants, or tangible things like gold coins or shares or other houses, whatever. If you're that sort of person, I think I would carry on investing your money and keep your mortgage going because you can afford to pay the interest. On the other hand, if you're somebody whose job is somewhat precarious and you don't know if you'll have much income tomorrow, it would make sense to reduce the risk that you'll suddenly lose. It makes sense to reduce your exposure to the interest on that mortgage by reducing the mortgage. So, if you are not in a very good financial position, then I would be working very hard to repay the mortgage, and I wouldn't go into the situation of trying to gamble on maybe I'll get a debt jubilee and save it all. But there's going to be obviously a limit. Most people won't be practically. Most people can't repay their mortgages. That's why they're taking out 20 or 30-year mortgages. If they hadn't, literally having, there's a few people around there who have cash on one side and the mortgage on the other. But that's a very unusual situation. In the UK, I have something called the offset mortgage, where you can deposit cash and you can borrow money, and they don't actually charge you on the mortgage, but they don't pay you any interest on the cash either. But in most people who do, this is a very rare situation where someone's got enough cash to pay off their mortgage. Usually they don't, because they've taken that cash and invested it somewhere else, because it makes no sense to pay, let's say, 6% on your mortgage and earn 2% or 3% on your cash. So, and then you pay tax on the interest you've earned. So 90% of the population, 95% would say that doesn't make sense to have that cash. If I'm going to keep it in cash, I'd better pay off the mortgage. Otherwise, I'm going to invest it in something more useful.
I think that's very good insights there. I think, reducing liabilities is almost always a good thing, especially, as you mentioned, it really depends on your own financial security there. So I did want to ask you if our viewers are interested in learning more and hearing more about the potential of a CBDC reset or all the other topics that you discuss on your LinkedIn. Can you share with them what they'll find and also where that is?
I write articles once or twice a week. My articles cover things like government debt, the Federal Reserve, the employment numbers, stock market, equities, Bitcoin as well, and of course gold. I've done quite a few articles on gold in the last year because I felt that the time was right. And the consequence of that and these sort of videos, I get a lot of questions coming in. I get several per week. And I'm quite happy to answer your questions. I just looking at some of the ones I had in the last few days, for example, just to illustrate the kind of questions. I had a guy called Leonid asking me if I think the Treasury in the United States has been secretly selling all its gold. And a guy called Ravi asked me what would be the result of a Monte Carlo simulation on 25% cash, 25% S&P, 25% NASDAQ, and 25% Indian stocks. And so when I get these sort of questions, if I can answer them, I will answer. Philip, there was a guy called Philip asked me about the offset mortgages, which I answered the question just a minute ago. And another one who asked me this week, he said, what happens if we do get this CBDC? How am I ever going to sell my gold? Well, the answer to that one was very simple. Anything you sell will have to go into your CBDC wallet. I don't think they're going to ban gold. There's no reason to think that they should. I mean, I know they did in 1933, but the reason for that was the government needed the gold to pay its bills, which were owed in gold. But we're not in 1933. Governments don't pay their bills in gold anymore. So why would they need to confiscate your gold? So if you have gold or anything else and you want to sell it, go ahead and sell it. But the buyer will have to pay from his CBDC wallet to your CBDC wallet. So as far as I'm concerned, nothing much has changed, except it's not anonymous anymore.
Fantastic. Well, Clive, we really appreciate your time today, as always. Thank you so much, and God bless.
Thank you, Elijah, and thumbs up for all your viewers.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 23rd through September 30th, 2024, while supplies last. First, we feature the 1-ounce gold Argor Heraeus Dragon Bar at just $69 over spot. Next, the 2024 1-ounce silver American Eagle is just $5.25 over spot, the lowest premium in months. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.